Then friends, we have the different questions. Bits, November 1997. Discuss the validity of the proposal to rectify the proceedings under section 154 under the following circumstances. Despite of the intimation of the death of the SC, assessing officer had completed the assessment without bringing the legal representatives onto the record. This order is sought to be rectified by bringing the legal representatives on the record. When somebody died and information is given, the assessing officer is duty bound to bring the legal heirs onto the record and then complete the assessment. If he has not done, it's a mistake apparent on the record, so it can be very well be rectified under section 154. Then the next question is, in an assessment, credit for the tax deducted source had been taken according to the assessment year of the payee. This is sought to be changed to the assessment year with reference to the date of issue of the TDS certificate by the payer and withdraw the interest granted earlier under section 244. As far as TDS is concerned, how the things should go. Tax credit of the TDS is allowable in the year in which the income is offered, and in the present case tax credit has rightly taken according to the assessment year of the payee as per section 199. There is no mistake apparent from the record. For which year you have offered that particular income, that TDS will be given a credit for that particular year only, is the knowledge which you should have, right? Because many times in the practical life also this is the biggest problem. Write down this one point. As per section 199, tax credit of the TDS is allowable in the year in which the income is offered for taxation. In the year in which the income is offered to the taxation. Another question is, the assessing officer omitted to grant to the SC interest under section 244 1A on the refund found to be payable in an order passed in pursuant to appellate order. SC is seeking grant of the said interest. See, once a refund is to be given in pursuant of the order of the appellate authority, interest is payable on such a refund. At what rate, friends? 0.5% per month is the interest. If this is known to you, you can very well do with it. In case without interest, in case if the assessment order is passed, then that gives rise to a mistake apparent from the record. Then the most beautiful part is, the SC claim for double taxation relief was rejected in the original proceedings as there was not even an evidence of tax in the foreign country. SC now seeks rectification on the strength of the documents. See, documents coming in the position of the SC subsequently do also constitute the record. So if on the basis of the documents no further investigation is required for double taxation relief, it is prima facie admissible, then the rectification under section 154 is possible. At the beginning, when the original assessment is passed, at that point of time I don't have the evidence. Subsequently I got the evidence, so I am saying that there is a mistake apparent on the record. So you can you go for rectification? Very well, you can go for rectification. Record includes the record which is subsequently obtained even after the completion of the assessment. So this is one thing, and AOP is there, and AOP has got income. That income is not assessed in the hands of the AOP. Individually the members offer that particular income. Later on it is found that it is actually liable to be taxed under in the hands of the AOP. Can later on it can be taxed in the hands of the AOP? Yes. Just because that income is taxed in the hands of somebody else, you can't say that the other person can be left free. So merely because someone else is taxed in respect of a particular income, it does not prohibit the assessing officer to tax the correct person with respect to the such income is a point you please remember. Keeping in view of the time, I am not making you to write. Then friends, May 1997 question. See, examine the validity of the issue of notice under section 148. That's what I am saying. The whole assessment procedures 148, 154, 263, 264, time limits for issuing the notice, completion of the assessments. This is the what the whole thing revolves around. Where SC has already served with an intimation under section 143(1), can a notice under section 148 can be issued? The answer for that is 143(1) intimation diye bolke, that is not an assessment order for you not to think about 148 notice. What we are saying, notice under section 148 can be issued even if intimation is given under section 143(1). Where a reassessment has already been made under 147. Just because reassessment is done, one more time can you issue a notice under section 148? Even if earlier assessment is a reassessment, still in case if there is a reason to believe that income escaped the assessment, very well you can issue a notice under section 148. Then the third bit is where a notice under section 148 has already been issued and the proceedings are still pending before the assessing officer. If there is a pending proceeding under section 148, very well the assessing officer during the course of that particular proceedings can visit any type of income which escaped the assessment. So when already the proceedings are open, again there is no need for issuing another fresh notice for another income which escaped the assessment, which is noticed then. So the point of interest is, if already there is a pending proceedings under section 147, again there is no need for you to make a fresh issue of notice under section 148. Already 147 assessment got completed, subsequently you found there is an income escaping the assessment, then you please issue a notice under section 148 is a point. Can November 1996 question, is it permissible to make any fresh claim of deduction of items not raised during the regular proceedings? Point of interest is, can you make a fresh claim for the deduction of the items? If your assessment got completed and if that is not challenged, appealed for, then in respect of an assessment which found the finality, in respect of that income you can't bring a fresh claim of deduction. If there is an income escaping the assessment, against that income escaping the assessment you can very well bring the fresh claims, is a point which we have already studied. Is it open to seek a review of a concluded issue? Already we have studied in Sun Engineering Works Supreme Court judgment. A matter which is concluded in the original assessment proceedings cannot be permitted to be agitated in the reassessment proceedings, is what we have well understood. And then friends, November 1995 question. See, all these questions we are discussing, now I stopped making you to write for the simple reason all these points are well written. An assessment was made on X originally in the status of a non-resident. Subsequently at the time of reassessment they found that status is not correct. See, what is the point that we are looking at? If you are a non-resident, only Indian income is taxable. If you are a resident, your global income is taxable. Later we found that your status, what you have claimed, is not correct. Can we change your status and can do the assessment? Very well, you can do it. Then friends, a non-resident individual was assessed originally on the income arising in India. Of course, here let me look at this particular point in this way. Notice in respect of the income escaping the assessment. If that is in case of a non-resident, you have to serve that notice on the agent. On the agent, what is the time limit for serving the notice under section 148 is only 2 years. Because 149(3) says what? If a person on whom notice under section 148 is to be served is a person treated as an agent of a non-resident, then notice shall not be issued after the 2 years from the end of the relevant assessment year. Just make a note. that is on the agent of non-resident, on the agent of the non-resident, notice cannot be issued under section 148, under section 148 after the expiry of 2 years, after the expiry of 2 years from the end of relevant assessment year. I quickly move to an issue. Of course, I will not make it right. What is the basic distinction between 142.1 and 143.2? Because these type of questions used to come when Mr. Chakravarti is writing his exam. Those are good olden days, I believe. When I am looking at the recent questions, and in those days questions, we are all most privileged students. Because this question as it is there in the cyclostyle notes which we used to get from Madras. The tax guru T.N. Manoharan's book, as it is, this used to be there. Happy well we used to read and reproduce it, right? Because in those days, let me again and again remind you that confusion is very less, because you don't have these many authors who are masters of cut, copy, paste. The originality of thought used to be there. Of course, again, the legendary, I can say, for this generation is Vinod Gupta ji, because the style of presentation really makes me to love and live to explain or to remain as a teacher. Because as a teacher also, the limitation is how well I present before the student. Unless legendary figures like this are there, it would be virtually not possible for beginners like us to become chartered accountants or teachers. Pranams to them, and look at section 142.1 and 143.2. What is the basic distinction between these two sections? Friends, try to understand 142.1 is a notice. If you don't file the return of income, they will ask you to file the return of income. If you have already filed the return, they will ask you for books of accounts and documents. Whereas your 143.2 notice is notice for taking up your case for the reassessment. Then time limit for issuing of a notice, as such there is no time limit for issuing the notice under section 142.1, whereas for taking up your case for regular assessment under 143.2 notice shall be issued within 6 months from the expiry of from the end of the financial year in which the return is furnished. See, for how many number of years that is books can be called for? Through 142.1 notice, maximum 3 years books of accounts can be called. Of course, under 143.2 they can call for any number of years books. That is, in case if you don't file the return also, you can you get a notice? Yes, under 142.1 it is possible, but under 143.2 unless you file a return, they cannot issue a notice under section 143.2. Is the approval of joint commissioner is required? Yes, in respect of the assets and liabilities which are not shown in the balance sheet. For that, if you want information, for you to issue a notice under section 142.1, you have to take the approval of the joint commissioner, whereas no such approval is required under section 143.2 is the point. So these are basically the points of distinction. Of course, noteworthy point is only one thing at the final level. What I feel is, that is, please remember forever, without a return being filed a notice under section 143(2) cannot be issued is a point. Then friends, the issues broadly are the one which are being well repeated, so I am not very much bothered that we should do it in toto, but maximum I covered, because these are all many times repeated. Finally, before I conclude this discussion on assessment procedures, let me do one more thing, which is a very famous question, at least when I am preparing for my exam. What is the basic distinction between 142(2)A and 44(AB)? 44(AB) is a tax audit, 142(2)A is a special audit. As all you know, first thing is, which is compulsory. 44(AB) is compulsory if the conditions prescribed therein are duly complied. Like if the turnover is exceeding 60 lakhs, or in case of professionals, if the gross receipts are exceeding 15 lakhs. Earlier it used to be 40, 150% of the 40 is 60 lakhs. Earlier it used to be 10, 150% of the 10 is, what is it? 15 lakhs. And this special tax audit comes in which situation? If the assessing officer feels that the books are not proper, or he is not able to follow that particular books, then he can very well ask the SC to undergo the special audit under section 142(2)A. Who appoints the auditor in case of 142(2)A? It is the chief commissioner who appoints the auditor, whereas SSC appoints the tax auditor under section 44(AB). What is the time limit? Time limit is prescribed under the notice under section 142(2)A. That is within that time limit. Of course, in any case it cannot be extended beyond 180 days, whereas the time limit here is 30th September. Of course, if you are also exposed to the international transactions where you have to, that is the transfer pricing report you have to take from the chartered accountant, means the date is November 30th. What is the consequence of non-compliance with 142(2)A requirement? Your case can be taken up for the best judgment, whereas here penalty can be levied under section 271(B) is a point. What is the penalty, friends? There is also 150%, 0.5% of the turnover, or rupees 1,50,000. Then opportunity of being heard. Of course, it is only you who is appointing the auditor under 44(AB). So while taking the things which are specified under 44(AB) audit, again fresh opportunity of being heard will not be given, whereas under 142(2)A, that report independent chartered accountant is doing. So of course I am not saying that under 44(AB) there is no independence. Independence is there, but much more independence in 142(2)A. So before the department takes into consideration of that report, an opportunity of being heard must be given to the SSC is a point. These are broadly the issues which we covered in the topic of assessment procedures. Hope so all of you will enjoy with those points your examination. Thank you.